Scotiabank kicked off Canadian bank results with an earnings beat. And for more on that and his investment strategy, joining us now is Philip Petursson, Chief Investment Strategist at IG Wealth Management. It's good to have you join us. Thanks so much.
Good to be here. Thank you.
So first of the big five banks to report today, Scotiabank, what do you make of what you saw in their earnings report to start?
Well, it was a strong report. I mean, you could see that they beat on a number of different metrics. The interesting thing is that the market had already built in really, really high expectations in terms of not only Scotia, but I think the rest of the banks as well. So that's why you're not seeing the market respond to what is we would argue, a pretty solid beat on both top and bottom line.
So do you think that's the same story for the rest of the banks then over the next couple of days? Like things are already kind of baked in, you're not going to see much market reaction?
That's exactly it. I mean, the biggest challenge with the banks isn't going to come from the earnings side, or it's going to come from the economic side. That's pretty solid. And we think with a steepening yield curve, the banks will continue to generate strong growth through 2026. But the challenge is in the valuation. It's that these high expectations are already priced in. If you're looking at the banks on a price to earnings basis or a price to book basis, they're trading near the higher end of the past 15 to 20 years. So there's not that much more upside other than what earnings are going to deliver. And again, a lot of that is already priced into these stocks at the moment.
Interesting. Okay, so let's take a wider look at the markets, the North American markets. Obviously, 2025, a year largely dominated by the Mag 7. Do you think we're seeing a bit more kind of breadth in the markets over 2026? Or what sectors do you think might dominate, if any, in 2026?
Yeah, we're seeing a really interesting start to the year of 2026. So a couple things that we note. One, there are some themes that are rolling over into 2026, gold in particular, precious metals, and we're having base metals participate as well. So the materials sector continues to lead the rest of the TSX. But where we're seeing a bit of a rotation, both in Canada and in the United States, is away from the tech-heavy names into the, as we've been hearing about them, the asset-heavy names. And so if you look at the performance of the sectors on the TSX year to date, it's been materials followed by energy, and then you have utilities and staples. In the United States, it's quite similar. So what led last year isn't leading now. And in fact, if you look a little bit closer into the United States, we see about 30% of S&P 500 constituents trading lower or more than 20% off of their 52-week highs. So you're getting, even though the market is flat, you have a good rotation from the more expensive names into cheaper names, keeping the S&P 500, like at that even level year to date. But underneath it, we're seeing better breadth and a healthier market overall.
Interesting. In terms of AI-related stocks in general, there's obviously been a lot of concern, it seems, from investors at the beginning of this year, particularly in terms of what other sectors AI might affect. What's your kind of further long-term outlook for how AI stocks are going to do this year?
Well, I think some of them are being overly punished. To assume that the cybersecurity stocks are no longer going to provide value going forward, I think is a huge mistake. To think that Microsoft doesn't have exceptional value in this company is a huge mistake. And yet it's trading cheaper on a trailing and forward basis than Coke, than McDonald's, than Yum Brands, than Walmart. And we would say, in what world does this make sense? And this is the challenge that we have right now. There are some really attractive opportunities starting to pop up in the technology sector that investors and active managers may want to take advantage of.
Let's talk a little bit more about your investment strategy for this year, because you say you've been preparing for kind of like a rotation out of the U.S. Is that right?
Exactly. Yeah. Over the past year, pretty much since Liberation Day, back last April, we have shifted our portfolios to an overweight the rest of the world, if you want to think of it that way. So we've maintained an equal weight position into the United States, although we're starting to think that maybe we want to pare that back. But we've been overweight Canada, overweight international, and overweight emerging markets, because these are the areas that offer better margin of safety in terms of the price that you're paying, reasonable valuations, and yet comparable earnings growth to what you can find in the S&P 500.
Do you think that's what investors should be doing, looking more into like emerging markets instead?
Absolutely. If you think that the U.S. dollar has some weakness further ahead of itself, which we believe we do, and you want to favor greater valuation, then emerging markets that have been a stellar performer so far year to date, we think can continue through the remainder of the year.
Are your clients receptive to that idea? I mean, for some, it could be maybe a little anxiety-inducing if you've never invested in emerging markets before.
It can be, but it's funny. A lot of our clients are more willing to shift away from the U.S. And in fact, we would argue that our clients have a greater appetite to invest either domestically here in Canada or elsewhere outside of the United States, even though we want to keep a fair balance. We're not completely wholesale selling out of the United States, but we are trimming it back in favor of these other areas. So investors, we find right now, are very receptive to this broader international diversification rotation that we're seeing in the markets that are playing out.
You also say you favor equity over fixed income because the downside risks are small. How small are they?
Right. So what we do is we look at the probability of recession over the course of the next 12 months. So recessions tend to bring about the really capital destruction bear markets that we want to avoid. We don't see any material signs of recession over the course of the 12 months in front of us. We think that the recession risk is fairly low. And in the environment that we believe that we're transitioning to over the course of the next year, you tend to see an 85% probability to the upside for stocks, meaning 85% of the time you see a positive return out of stocks, whether that's U.S. stocks or Canadian stocks. So with yields where they are today, you can get better returns out of fixed income without taking on significant downside risk. Notwithstanding correction, we can get a correction at any point in time, but it's the bear markets that we want to be sensitive to. And we just don't see a high probability of a bear market emerging over the course of the next year.
Interesting stuff. We'll have to leave it there. Philip Petursson, Chief Investment Strategist at IG Wealth Management. Appreciate your time. Thank you.